If you're new to investing, it can honestly feel like you're standing at the edge of this massive, confusing ocean, right? Do you just jump in and, I don't know, hope for the best? What if there was a map? Well, today we're building that map together. We're going to replace all that guesswork with a clear, repeatable framework that puts you back in control of your financial future. So let's dive in. So let's just start with the biggest question of all. Is investing just a fancier, more sophisticated form of gambling? Is it really all about getting lucky, picking the right stock at the right time because you have a hunch? Or is there a professional, repeatable process that separates the pros from everybody else? This is the core distinction we have to make before we even think about putting a single dollar to work. And this quote, man, it just gets right to the heart of it. The moment your strategy becomes, well, I hope this stock goes up, you've stepped out of the world of investing and straight into the casino. Because hope is not a financial plan. It's really an admission that you've given up control. Professionals, they don't rely on hope. They rely on a system. So what's the antidote to just hoping? It's a system. And the system we're exploring today is built on these 4 pillars of investing. Now look, this isn't about some hot stock tip or a can't miss trend. It's a foundational framework, a set of criteria you can use to evaluate any potential investment. I'm talking stocks, real estate, even crypto, and make decisions based on logic, not emotion. This is how you take back control. All right, here's our roadmap. First, we'll get our heads straight on what it means to invest with a system. Then, we are going to build our foundation, one pillar at a time, finding value, then timing the market, creating cash flow, and finally, mastering risk. After all that, we'll see how the pros put it all together using a top-down approach to find the absolute best opportunities. You know, when I first started learning all this stuff, I really thought that successful investing was some kind of sixth sense, a gut feeling that legendary investors just had. But that's not it at all. Professional investing is a learnable process. It's all about setting clear criteria for what makes a good investment for you, and then just systematically searching for assets that check those boxes. You're shifting from being a passive passenger to an active pilot of your own money. Okay, let's build our first pillar, finding value. This is the world of fundamental analysis. Before you can ever decide when to buy something, you have to answer a much more important question. What is this thing actually worth? Is this a strong, healthy company, or is it kinda on shaky ground? This pillar is all about figuring out the true intrinsic value of an investment. So what do we actually mean by fundamental analysis? Well, think of yourself as a detective. You're not just glancing at the stock price. You are digging for clues about the underlying health of the business. This means looking into economic reports, reading company financial statements, understanding industry trends, even the quality of the leadership. You're trying to understand the whole story, not just the headline. Now, fundamental analysis isn't just one thing. It actually happens on 3 different levels, kind of like a pyramid. At the very top, you have the sovereign level. That's the big economic picture. Think interest rates, GDP growth, that kind of stuff. Then you zoom into the corporate level. How are the company's earnings? Is their revenue growing? But, and this is so crucial, it's what most people miss, the foundation of the entire pyramid is the personal level. What are your financial goals? What does your personal balance sheet look like? Because trust me, if an investment doesn't fit your personal situation, the other 2 levels just don't matter. So before you go analyze Apple or Tesla, you have to analyze yourself. Seriously, professionals know their own numbers cold. These 7 figures right here, these are your personal fundamentals. First, from your income statement, your income, what comes in, your expenses, what goes out, and the most important results of all, your monthly cash flow. That's the money you have left over to invest. Then, your balance sheet, your assets, what you own, liabilities, what you owe, and your equity or your net worth. This tells you your overall financial health. And finally, your credit score, which is basically how banks see you. If you don't know these 7 numbers like the back of your hand, you're just flying blind. And here's a perfect example of why these fundamental definitions matter so much. For decades, we've all been told your house is your biggest asset. But is it really? Robert Kiyosaki came along with a super simple, powerful definition. An asset puts money in your pocket. A liability takes money out of your pocket. Well, your primary home has a mortgage, taxes, insurance, maintenance. All of these things are taking money out of your pocket every month, which makes it a liability by this definition. A rental property that generates positive cash flow, on the other hand, now that would be an asset. This little shift in perspective is the absolute essence of fundamental thinking. All right, let's move to our second pillar, And you'll see how this all builds. Once you've done your fundamental homework and decided what you want to buy, you found a great company at what looks like a good value, the next question is, when is the right time to pull the trigger? A great company bought at the wrong price can turn into a terrible investment fast. This is where technical analysis comes in. Now, technical analysis isn't about predicting the future with some crystal ball. Not at all. It's really the study of supply and demand, just visualized on a chart. Think of it like reading a weather map for the financial markets. The price and the volume patterns on a chart, they tell a story about the psychology of the market, whether buyers, which is demand, or sellers, which is supply, are in control. It helps you see the path of least resistance for the price. And honestly, at its core, technical analysis is pretty simple. A market can only do one of three things, like you see here. It can be in an uptrend, with prices generally heading up. It can be in a downtrend, with prices heading down. Or it can be moving sideways, just kind of chopping around, not really going anywhere. Your first job as a technical analyst is just to identify the current trend. You want to invest in harmony with the market, not try to swim against a powerful tide. Now for our third pillar, and this is the one that really gets me excited, because it is the absolute key to financial independence. It's all about creating cash flow. Most people think you can only make money when the market goes up. But professionals, they know how to generate income whether the market is going up, down, or even just sideways. So there are really two main goals in investing. The most common one is capital gain. That's the classic buy low, sell high. This whole strategy is focused on increasing your net worth. But a lot of professionals focus on a totally different goal, cash flow. This is about acquiring assets that generate regular, spendable income month after month. I mean, think about it. Your net worth doesn't pay your bills. Cash flow does. The goal here isn't just to be rich on paper, it's to be financially free, where your passive income covers all of your expenses. Okay, check this out. This slide shows the incredible power of using different cash flow strategies. Imagine your analysis tells you a stock is probably going to drop from $100 down to $50. A traditional way to profit from this is called shorting the stock, which could give you a 50% return. And hey, that's great, but there are other tools in the toolbox. For example, by using something called an option, specifically a put option, which is a bet that a stock will go down, you could potentially see a much, much higher return, like 1,500% on the exact same price drop. We won't go deep into options right now, but the key takeaway is this. Knowing different strategies allows you to create cash flow and even amplify returns in any market direction. And that brings us to our fourth and final pillar, and I really can't stress this enough. This is the most important one of all. Mastering your risk. So many beginners focus only on the upside, how much money they can make. Professionals are obsessed with the downside, how much they could possibly lose. See, risk management isn't about avoiding risk. That's impossible. It's about knowing the risks, planning for them, and controlling them. So what even is risk management? At its heart, it's the process of protecting your capital. Your number one job as an investor is capital preservation. You can't play the game if you run out of chips. I like to think of it as a toolbox. When you start out, you have a few basic tools, right? But as you gain experience, that toolbox becomes a tool chest, and eventually a whole garage full of tools to manage any situation the market decides to throw at you. This, right here, this illustrates the single most important mindset shift in risk management. You have to separate what you can control from what you can't. You can't control the market. You can't control the news or what the Fed does. Wasting your energy and emotions on these things just leads to bad decisions. The key is to focus 100% of your energy on what you can control, whether you get in or out, your exit strategy if you're wrong, and how much of your money you put at risk. That's it. That is where all of your power lies. So how do you actually do that in practice? Well, every single trade you make must have this simple 3-point risk plan. Before you even think about clicking buy, you need to know 3 numbers. Number 1, your entry price, where you get in. Number 2, your target price, where you plan to take profits if you're right. And number 3, the most important of all, your exit price, or your stop loss, where you will get out and take a small manageable loss if you're wrong. This is your lifeboat. Never get on the ship without one. Okay, so we've built our 4 pillars. They are the foundation. Now, how do we build the house? Right? How do we put all of this together into a cohesive, repeatable process that we can actually use to find investment opportunities? Well, professionals use what's called a top-down approach. This whole process works kind of like a funnel. You start really broad, and you get more and more specific. So, step 1, you look at the broad market, something like the S&P 500.
Is the overall market trending up? If the answer is yes, you proceed. Step 2. You identify the strongest market sectors. Let's say you see technology is just outperforming everything else. Cool. Step 3. Now you dig into the industry groups within tech. Maybe you find that semiconductors is the leading group. Step 4. It's only now that you finally start looking for individual stocks. You'd search for the strongest semiconductor stocks in that group. And then step 5, once you have a candidate, let's call it company X, that's when you apply our 4 pillars. You analyze its fundamentals, check its technical chart, pick a cash flow strategy, and you set your 3-point risk plan. It's a completely systematic way to find the needle in the haystack.
I want to leave you with this thought from Robert Kiyosaki. This 4 pillars framework, it's not just a trading system. It's a form of financial education. It's the education that, let's be honest, most of us never got in school. It's all about moving from simply working for money to actively building a system where you truly understand how to make your money work for you. And the only question left is, are you ready to learn?